Well, good morning, everyone. It is the appointed hour, and I'd like to go ahead and call the February 9th, 2017 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on the agenda is to approve the minutes of the meeting of January 12th. I have a motion and a second. All in favor? Aye. All opposed? Motion carries. Item 3, we have some presentations this morning. Our first will be from Ernest Partners. Jason, is there anything you'd like to brief us on?
Just a routine update, as we haven't had these two small cap managers in for a while. So you have your two U.S. small cap equity managers, Ernest Partners on the value side, and Times Square on the growth side. So turn it over to these guys.
All right. Well, good morning.
Good morning. Usually we try to keep these to about 20 minutes or so, and then that'll leave us a couple minutes for Q&A at the end.
Got it.
Okay.
We were going to talk about every name in the portfolio. Just kidding. We'll keep it to the 20 minutes. Well, first of all, thanks for having us in. I've been here several times in the past, but it has been a couple years. So just as a reminder, my name is Pat Malcolm. I'm one of the partners at Ernest, and this is Sarah Al-Muqaddam, who's responsible for product management at Ernest Partners. So there's a short bio on both of us at the beginning of the book, but we'll go ahead and kind of jump into the markets and the portfolio and give you an update. If there's any questions, you don't look like a shy group, so feel free to jump in and ask questions as you would like. So let me start with, first of all, the guidelines. That's something that we take very seriously. We make sure that we monitor that every time we make a trade, every time there's changes in market prices, and we monitor that. If there's changes, please communicate that, and we'll make sure we keep that updated. We manage the SMID value portfolio on your behalf. We've been with you for 14 years at this point, so we appreciate the partnership over that period of time. Over that period of time, the annualized rate of return is almost 15%. So it's a very strong absolute return. Almost 12%. 3 years is at 15%. So almost 12% over 14 years annualized rate of return, which has outpaced the benchmark that you've assigned to us by about 100 basis points. So very consistent performance over time. Our style, the way that we invest, is a little bit unique in that what we've tried to do is we've tried to go out over the years and build a team of people that come from an industry. So we don't really want to go out and just find someone that spent their entire life behind a Bloomberg machine looking at 10Ks and 10Qs. We want to find people that have worked in an oil field, have worked in an industrial company, have worked at a technology company, have worked in a healthcare company, maybe have practiced medicine. With the idea being is that if we can assemble a team of people that have come from industry and then turn around and look at those industries from an investment standpoint, we have the ability to look at companies from the perspective of a practitioner as well as an analyst. And we think by doing that over time, it gives us a better chance of finding good investments, and that's what we've done on your behalf. So that's how we structured this portfolio. Now, there is a market review tab in here, and we wrote a commentary in there. I won't read through the commentary, but let me just share with you kind of the environment that we've come through over the last kind of 12 to 13 months. If you had to pick one word for this last period, it's really been volatility. I mean, think back on this time a year ago, the markets in 2016 were down almost 10%. Now, why were they down 10%? Because people were really worried about growth. People saw the emerging markets kind of decelerating. They saw Europe and Japan where there was stagnant growth, and there was a lot of concern here in the U.S. in terms of is there going to be any growth, and the markets reacted by selling off pretty hard. So it didn't matter which asset class you're in. January of 2016, the markets were really down. Then the market started to recover as people realized that it wasn't as bad as what people had suspected. And then you had Brexit. And what did the market do there? Again, uncertainty, and it sold off pretty hard. Then it came back, and then you had the election. The United election, futures were down at one point, over 500 basis points, and then it recovered since then. And so you had this volatility as you had a lot of news events throughout the year. But if you just kind of looked at it from the beginning of January to the end of December, it was actually a really good year if you looked at it just from that standpoint. And one of the things that we try to do as an investment management firm is we're not managing it week to week or quarter to quarter or really even year to year. We're looking at companies and we're saying, hey, what are they going to do over the next 3 to 5 years? Are these companies that are going to be able to compete over the next 3 to 5 years with their competitors, and how much do you have to pay to own that business? And there's going to be good times, there's going to be bad times, but if you can own the companies that are really going to be able to compete and you're paying the right price, then over the course of 10, 14 years, that's how you generate good returns. And so that's kind of what we've done on behalf of you for this portfolio. And we kind of continue on into 17, and our feelings now are you're going to continue to see some of the volatility that you saw in 2016. But again, we try not to turn on the TV every single day and try to make investments based on that. We look at the fundamentals of the business. So that gives you a sense for the market. Now, getting into the portfolio itself, if you go to the portfolio review tab, this will give you a sense for some of the specifics on your portfolio, and I'll let Sarah talk about that.
Yeah. So as Pam said, if you turn to page 5, we've included a snapshot of your portfolio as of December 31st. So the ending portfolio value was of about $48 million. With the yields on equities of 1.4%, that gives you an estimated annual income of about $634,000. Now, the pie chart that we have at the bottom of the page is just to show you that we remain fully invested in your portfolio with about 2% for transactional cash purposes. Now, if you turn with us to the next page, on page 6, we have performance on your portfolio. Now, performance has been strong, it's been consistent. The mid-cap value space has been a great allocation decision. Looking at the last 1 year, now I do want to point out we do have performance updated as of January 31st. All the other information that we have in the book is as of the end of the year, but we want to give you updated performance. So as of January 31st, looking at the 1-year number, the portfolio is up 35% versus the benchmark at 34%, giving you an excess return of about 85 basis points. Looking at longer term, the 3-year, we're up 11.4% versus the benchmark at 9.4%, giving you 200 basis points of excess returns on an annualized basis. And then looking at the since inception, most importantly, since inception, we're up 12% versus the benchmark at 11%, giving you an excess return of 93 basis points. And just to give you an idea, that's almost 396 percentage cumulative returns since inception. Now, I know I keep talking about performance in percentage terms, but we know you pay your benefits in real dollars to real people. So what all of this really translates into is on the following page, on page 7, where we've included a chart that shows, just to give you an idea of how your portfolio evolved ever since you invested with us back in 2003. So you invested with us about $17 million back then, and over our management mandate, you withdrew about $17 million, so the same amount. But because of investment performance, we've been able to generate on your behalf $48 million. So that's almost 250% of what you invested with us back in 2003, giving you an ending portfolio value of about $48 million. Now, you may ask yourself, how are we able to generate performance on your behalf? It's really because of stock selection. Our investment team spending their time researching, scrutinizing names, making sure that we're getting to the right names on your behalf. So we wanted to give you a sense of some of the names that we hold in the portfolio for you. So on the following page, we have 3 examples of names that did well, as well as one name that didn't do as well during the quarter, just to give you a sense for what we have. One name that I did want to talk about really quickly is Darden Restaurants. Darden Restaurants is a name, I'm pretty sure most of you know some of the restaurants that they own and operate in the country. If you think about your casual dining restaurants such as Capitol Grill, Olive Garden, Longhorn Steakhouse. So those are some of the restaurants that they own. They have about 1,500 restaurants in the country. And what we've seen is that they operate in the casual dining industry. And there's a trend that's been shifting, going from the casual dining industry going to fast casual restaurants. So we think about your Chipotle. So moving away from casual dining, which is going in with your family to spend 2 or 3 hours, sit down in a sit-down restaurant, going to a fast casual restaurant, which is a restaurant where you go in looking for higher quality food and spending less time at the restaurant. So there's been pressure on the space. But what we like about Darden restaurants is that they've been able to retain their clients. They've made changes to their menus. And as a result of that, they've been able to grow their same-store sales growth. And as a result, the stock was up 19% during the quarter. So that's just one of the names that we own in the portfolio on your behalf. And if we combine all of these theses that we have for all of the names that we have in the portfolio, that gives us about a 50 to 60 stock portfolio with the sector allocations that we have on the following page, on page 9. Now, this just shows you where we're finding more opportunities on your behalf in this mid-cap value space. Your portfolio is going to be to the left in blue, and then the benchmark is going to be to the right in red. Now, as a reminder, we are a bottom-up fundamental investment manager, so any over or underweights that you see on this page, they're simply a result of where we're finding the best individual opportunities across all sectors. I did want to point out a couple of sectors where we do have an underweight, where we haven't been able to find as many opportunities for you. Some of them, like consumer staples, financials, and utilities, for example, where we do have underweights there. We just haven't been able to find names that have compelling valuations. If you think about specifically the financial space, because of the recent administration that's been in place, some of the financials names' valuations have been bid up a lot, and we don't think that it makes sense for us at this point to be in this sector. So where we have been able to find opportunities on your behalf instead, if you think about industrials, information technology, or materials where we do have overweights. If you think specifically about industrials, investors are discounting the sector as if it's never going to grow again, but we do know that there are opportunities within the industrial space, companies that are fundamentally strong, and that over time are going to gain market share and grow. Now, we are low turnover managers, so you will not see us make any drastic changes from quarter to quarter or from year to year. But we did exit a name recently from your portfolio called Energen. And Energen is a company based out of Birmingham, Alabama. It's an oil and gas exploration and production company. The stock appreciated more than 50% during the quarter. So that benefited the name, that benefited your portfolio. So it was time for us to get out of the name, and that benefited you.
Yeah, that was actually a unique situation in that usually we're holding names on average between 4 to 5 years, so about 20% turnover in the portfolio over time. But Energen was a case where we held it for a much shorter period of time. We held it actually less than a year just because the market realized the value quicker than we had anticipated, which we're not going to complain about that. And once it reached kind of full valuation, we decided to exit out of it. So with that, yeah, go ahead.
Talk about the financials exposure.
Yeah.
Cyril mentioned valuations.
Yep.
Particularly recently, but were you underweight going into the run-up?
Yeah, we were. And so financials this year has been interesting because up until last quarter, REITs, which you see if you're on page 9, you see how it has real estate here over on the right. It used to be part of financials. So your financials, the financials weighting, which is the largest sector in the benchmark to begin with, it was even larger than what it looks like on this page. And we've been underweight REITs. REITs have done well because they have a high yield and in a low interest rate environment. A lot of those securities did well because of the yield, not necessarily because of the fundamentals. And so we felt that it's a little expensive, and we've been able to find relatively better opportunities elsewhere. But then the rest of financials is really broken up into 3 areas. You think of financials as being diversified financials, so like your Raymond James, regional brokerage type concepts. Also your insurance companies within financials, and then your regional banks or your local banks there. And the biggest relative underweight that you see right here, because the portfolio is at 20 and the benchmark's at 27, comes from the banks. And so banks have done well. In fact, you know, some of the best names in the portfolio were banks. But as a general proposition, if you look at what happened this year, from the time of the election in November until the end of the year, a lot of the local banks were up to the tune of about 30%. They outperformed the benchmark by almost 2,000 basis points. Now, The reason that they were up that much, in our opinion, was not because the fundamentals had changed, not that they were able to go out and, extend more loans. Interest rates hadn't changed dramatically. A lot of the rules that are being contemplated in terms of maybe pulling back the amount of regulation on these banks, it hasn't changed yet. But what the market did was the market priced it as if all that stuff happened at the election and gave them credit for that environment, which would be better for banks. We look at it and say, first of all, pulling back regulation is a difficult proposition. The chances that it actually all gets pulled back or gets amended is not likely. And then secondly, to actually go out and when these regulations do get pulled back, it affects the big banks more so than it affects the smaller banks because a lot of these requirements on banks that have come on in the last kind of 4 or 5 years have affected those banks with over $10 billion in assets, since a lot of the banks that we're looking at are actually less than that. So there won't be an incremental benefit there. So we've been underweight banks throughout the year, and now with kind of the run-up that you've seen in banks, which has been somewhat of a headwind in the portfolio, that's starting to reverse itself so far in 2017, and one of the reasons that so far in 2017 the portfolio is outpacing the benchmark by about 150 to 160 basis points. But we do own other names in the portfolio, like a Raymond James, where you've got a regional banking concept that has been able to grow their footprint. They've been able to grow their fee-based business and kind of take market share from other players in that space. And then we own some insurance companies in there as well that have done well, given that you had kind of a low cat environment or big disaster environment in terms of them paying out their premiums. So that's kind of the positioning on financials. It is a decent underweight, but at the same time, it's a 20% weighting in the portfolio. So sometimes people would say, hey, well, isn't it a risk that if you're this much underweight financials? And we say, well, actually, the risk is having 40% of your portfolio in financials. We look at risk not only by our sector weightings, but we look at about 24 different risk factors in terms of what does your portfolio look like relative to the benchmark, and based on that, we try to set what we call a minimal acceptable return in the portfolio. And in fact, if you go to the next page, that actually highlights kind of some of the risk metrics. So we look at 3 different things here. For the first, it captures the volatility of the portfolio as measured by beta, and you can see that we're in line with the benchmark, and that's what you want. You want to be in line with the benchmark on that front. But at the same time, if you look at the diversification, in other words, where are the returns from your portfolio coming from, they aren't explained 100% by the market. They're explained because we're able to go out and find good individual names. So you want to see that diversification being less than 1, and you are down around 0.88. And then on the far right, when you talk about risk, what we've done is we've set a minimal acceptable return in the portfolio, and then represented to you and all our other clients that 88% of the time we're going to meet or exceed that minimal acceptable return. So we're keeping it within that risk spectrum, even though we're willing to take differences from the benchmark, like in financials, where we have a pretty sizable underweight. And then from a firm standpoint, there's been no changes. We have always been employee-owned. We think that that is the best form of ownership for what we do. It allows us to only have one line of business, so the only thing we do is asset management. Everyone in the firm wakes up every morning with the idea of going out and finding good investments on behalf of our clients. It aligns our interest with our clients. Being employee-owned, we only do well if our clients do well. And it allows us to run the firm with kind of a 3 to 5 year horizon in terms of investing in systems, investing in people, and attracting talent. So there's been no changes on that front. So happy to answer any other questions that you might have.
Any questions from the board? Hearing none. Thank you very much.
All right. Thank you very much. Appreciate it.
The next consultant is Times Square Capital Management. Good morning.
Good morning, sir. Good morning. My name is Jeff Bramer, from Times Square Capital Management. It's probably been about 3 years since I've had the pleasure of meeting with you all. Glad to be back here. Just very briefly, we're sort of, I guess, paired with Ernest, as Jason mentioned. We're on the growth side of things. Our focus is a bottom-up stock selection process. Our analysts are seeking the best names in the economic sectors that they're responsible for. From the bottom up, trying to find a good portfolio that will add value to your assets over time relative to this mid-cap benchmark. That process hasn't changed since the firm's foundation or since you all hired us in 2010. But I feel like before I go much more into firm, I should talk about performance, because over the last 3 years, our numbers have certainly not met our expectations, or I'm sure yours. So let's talk a little bit about what's going on and what's been happening as far as your portfolio is concerned. So if you'd please turn to the third tab, we can go right to page 16, where we have our numbers relative to the index. And yes, it's good that they're positive on an absolute basis, but you hire us as an active manager to add value to a benchmark, and that's really what our goal is, and clearly we've not met that goal, particularly over the last 3 years. And a couple of different things have been going on during that period, and in terms of what's been happening, both headwinds as well as our individual stock selection. Now, over those last 3 years, we've had an environment that has been more geared towards certain narrow segments of the market, that in the small cap growth space, this mid cap growth space, particularly in 2015 and 14, you've had a very strong bull market in healthcare, namely biotechnology and pharmaceutical companies. Now, these are typically early stage companies that have unproven technologies, ones that haven't quite made it all the way through FDA evaluation, and ones that we tend to be, skeptical might be too strong a term, but we like to actually see companies that have earnings, that have sales and real cash flow, and particularly from a risk perspective. So we've generally been underweight those names, and you can see that somewhat on page 17, which gives you a snapshot of your portfolio as of year end. But certainly I can highlight the fact that that underweight in the healthcare area has been fairly consistent. And when we think about that, we say, well, there's certain service companies in healthcare that we like, but a lot of the names that make up the index, and that 18% of the index, represent biotech and pharmaceutical, which, although weak in 2016, though very strong this first month again, were very strong in 15 and 14. One other area that's, I think, given us a little bit of difficulty has been our exposure to energy. Now, you might say, well, 4% of the portfolio in energy, and probably over the time, around 2%, is not that great, given the fact that the benchmarks had almost no exposure there. And if you go back 3 years, oil prices were at 100. They've come down, backed up a little bit to 50. Any of the exposure we've had there has been very detrimental. Now, as I said, we're bottom up, and I'm not going to say, well, I think oil is going to be at 60 by the end of this year, or make any decisions based on that. What we're trying to do is find companies that are low-cost producers, whether it's oil or natural gas, try to keep that somewhat balanced because we don't have a view one way or the other, but they're able to increase their production, do it at a low cost, and be able to adjust quickly to whatever prices might do. But it's been a weakness across the board on a fair number of names. And we've repositioned the portfolio accordingly during the last number of years. Turning to page 18 to go into a little bit more about what's been happening in the last year, which of course then weighs on the last 2 and 3 years, so maybe that's a good way of thinking about it. I highlight here a number of the contributors and detractors in your portfolio. And as you see in the lower right, there are 5 names that took away from performance from you last quarter. 3 of those names are either out of your portfolio or in the process of being sold from your portfolio. And frankly, they're ones that we erred on. We thought they were much better than they were. And Cavium is a technology company that makes a unique chipset that's very highly specialized, not easy to replace for high-performance communications. But they kept pushing out their next-generation chip, a delay of 2 quarters in a row. And we said, well, we still like this business. It's unique, doesn't really have anything else that competes against it. So we thought it had a very strong moat around its business. Then last year they went and acquired a very much more commodity-oriented chip for data services, for servers that you might have in your back office or downstairs in your building. not a very attractive business from our perspective. We thought the company was moving away from its core competency, and as its stock price came down, we sold that name, though at a loss, clearly. Contrast that with someone like Advisory Board, which does healthcare consulting business. And with a lot of the weakness that healthcare institutions have had and concerns about their revenues, they've pulled back some of their spending. We think that's temporary. We think a lot of the services that Advisory Board is able to provide are very strong, and we've added to that position on its weakness. So trying to recognize what's going on with the individual names, cutting losses where need be, or also recognizing sometimes the market might just not recognize what we see as value. On the plus side, some of these names are relatively new names to the portfolio. 3 of them were sold to the portfolio because they were being acquired by other companies. We've sort of benefited from a number of acquisitions from larger companies taking out some of our smaller names. The question on financials and banks came up, and on the prior page you may have noticed we're quite overweight financials. Most of that tends to be on business service financials or payment processors. We're probably roughly equal weight on the bank sector. We started that middle of last year with SVB Financial as one of them, Silicon Valley Bank, which does a unique business serving venture capital clients in Silicon Valley and Palo Alto, San Francisco area. Much of these companies, as Patrick noted, have run up significantly post-election. We've trimmed back a lot of that. We try to be very active in our trading. Our turnover typically is about 50% a year. It was a little bit higher in the fourth quarter. There wasn't anything specific post-election that we said, okay, now we've got to sell this name and bring in this name because the world's different. The world is different, but nobody knows what that difference will be. And that difference expectation changes on a daily basis. What we do think is there are certain companies that will benefit from changes that are being proposed, certain ones that will not. And if we can sort of think about our shorthand is the red stocks versus the blue stocks, we don't necessarily know which is going to be better, but we find the best blue stocks, we find the best red stocks so that we can be well balanced in our portfolio come what may going forward. Just again, sort of thinking about our long-term experience and I think the unusual nature of the last couple of years, I'd also ask you to turn to just past tab 4 in the appendix where we have our annual calendar year numbers. And you can see the last 3 calendar years have been behind the benchmark. One thing that we haven't really seen in the market have been, it's almost been an 8-year bull market, nearly uninterrupted. And well, we're always concerned about the market. I guess we're naturally, I wouldn't say we're pessimistic, but I would say we're always worried. It gives us gray hairs, or what hairs we have left for that matter. What we're worried about is how this might shift. And our portfolio and our views are always, how do we preserve your capital in potential negative environments? How do we find long-term growers that might lag in a very rapidly moving upward market? We do care about valuation. We do care about the stability of that growth. And I think that's part of the reason why you see on the bottom here that in each of the negative quarters over the last 7 years and 10 years, this strategy has outperformed the benchmark when there's been a negative market. And it's just been a while since we've had a negative market. Not that I'm wishing for a negative equity environment, but I certainly wouldn't mind some of these high multiple names to come back down and valuation to be a bit more reasonable for an active management process. And with that, I'll take a breath and certainly be happy to answer any questions or ones you might have, Jason. Sure. So it's been 3 years since I've been here. We've only had one change as far as investment team's concerned. If you jump back, I think just past tab 2, page 9 is a good spot. As I mentioned, our process is one that is analyst-driven based on the economic sectors that their experience is in. Grant and Tony have been the co-portfolio managers since the strategy began. On our analyst group here, we had one change about 3 years ago. Our healthcare analyst, who'd been with us for about 14 years at that point, decided he wanted to start his own hedge fund to go both long and short in healthcare. We don't think in terms of going short names. It's a very different process for us. and it wasn't something that we were prepared to sort of either create for him or be able to offer to clients. So he decided that that was the best time for him to start it. To replace him, we brought in David Ferrara, the PhD in molecular biology, much like Wei Dong had before. And then we also decided that healthcare had become such a larger portion of the overall universe. Most people focused on either the FDA type of healthcare, the clinical trials for biotech pharmaceutical devices, and other groups focused on the healthcare services, so managed care, healthcare IT. And we decided that as that industry has really grown, it made sense to bifurcate and have two analysts covering that, much as we did many years prior with technology, having two people covering technology. So David and Samir joined us. They've now been here just about 2 years. Some long-term clients still call them the new guys. I've been here 9 years, so I still think of them as the new guys as well. But that's the only change in the investment team. That's what I'm here for. Sure. I always think about the question that, the future is now a bit more uncertain. And when I think about that question, I think, well, when is the future ever certain? Other than the sun rising tomorrow, it's never locked in place. Certainly it's gotten more uncertain, if only because we're not sure what direction a lot of different policies or different movements that the federal government might do will take place. What we can do is think about, and I guess I think about it more on a micro level, how it affects individual companies. So tax reform, corporate tax reform is a big topic issue. And there are companies that are domestically focused, industrials that pay the top rate. And there are others that might be software companies or pharmaceutical companies that pay single-digit corporate tax because of their Irish domiciled structure or other entities. And certainly you can expect there's going to be some sort of normalization there. So from a perspective going forward, we have to think, well, how's our portfolio look? Do we have too much in high-tax companies, too much in low-tax companies? Do we need to think about that as another risk factor when we look at our companies? And I think from that perspective, it's really just another dimension that we have to incorporate, much like for the last 4 or 5 years, we've been thinking about when interest rates might start to rise and how the portfolio might react to that. So from a micro standpoint, the analysts are thinking about that, domestic focus versus non-U.S. focus, the managed care companies that could benefit from a change in the ACA or those that will be hurt by it, and think about that as additional things that might cap their future return and target price. And then the portfolio managers have to think about how the overall portfolio is balanced, because we don't know. And I don't actually think anybody really knows. But can we make sure that the portfolio won't be too adversely affected one way or the other, no matter what happens? And as long as we have like I said, as long as we may not know whether it's going to be more blue or red, but as long as we have the best blue names, the best red names in the portfolio, that's what we're working on right now. Did that cover it enough?
Do we have any other questions? Okay, well, thank you very much for coming in. We appreciate it.
Thank you very much for having us.
Okay, moving right along on the agenda, item number 4 is the consent docket. We have 2 items. Have a motion, a second on item 4. All in favor? All opposed? Motion carries. On item, do I have to get a vote on this? Vote? We just, okay. Okay, under item 5, we have 3 items. I've been informed that we need to strike item number 5B, the domestic custody agreement with J.P. Morgan, and that will come forward next month? Okay. So I will entertain a motion on items A and item C. Have a motion and a second on item 5. All in favor? All opposed? Motion carries. Item number 6 is to approve the claims docket. Have a motion and a second. All in favor? All opposed? Motion carries. Item number 7 is approve the following applications for service retirement. We have 8 this month. Have a motion and a second. All in favor? All opposed? Item 7 passes. Item number 8 is to receive the report of death and approve continuation of pension to the spouse. We have 1 case. Have a motion and a second. All in favor? All opposed? Motion carries. Item number 9 is to receive the report of death, authorize payment of the $5,000 death benefit, and authorize the Secretary to make necessary changes to conform on the following. We have 2 cases. Have a motion, a second on item 9. All in favor? All opposed? Motion carries. Item number 10 is to receive the report of death, authorize the Secretary to make necessary changes to conform on the following. We have 2 cases. Have a motion, a second. All in favor? All opposed? Motion carries. Item number 11 is to approve the following application of vested rights. We have 1 case. Motion, a second on item 11. All in favor? All opposed? Motion carries. Item number 12 is approve the request of the following to terminate vested rights and commence drawing retirement benefits. We have 2 cases. Have a motion, a second on item 12. All in favor? All opposed? Motion carries. Item number 13, we have 2 items for individual consideration. Item number A is granting of the cost of living adjustment to eligible retirees and providing an effective date. Renee provided information in our packets this month. It looks like the CPI rose 2.1 for the 12 months ending December, so based on our policy, we are at liberty to grant up to a 2% increase in the cost of living adjustment for the retired employee, so I will entertain a motion. I have a motion and a second. Any
It's up to 2%.
up to 2%.
Are you ready? Up 2%.
Yeah. And the effective date. What's normally the effective date on these, Renee? How do we do that?
We have done various things in the past. We've looked at doing it 1/1 or doing it now, which would be February's check. If we do retro, it seems to confuse retirees more than it does anything else because their check is different in January because of their insurance premiums. The February check would have a retro, then March check would go to the normal amount. So the next 6 months, they're trying to figure out why they have different amounts in their checks because they usually don't start calling until March, April, and May. We made it February, yes.
I would move that, as February is the effective date.
Point of order, I don't know how to make a different motion. We're not giving them the full amount of retro. 2.1 is, I'm sorry, I forget. I'd like to propose a standard motion that it is 1/1. The concern is that it's inflation of 2.1. We're not even matching inflation anymore. The insurance has gone up dramatically. The people who are retired who backed off and took a lower insurance plan are now going to have to pay a lot more out of pocket. I know it doesn't seem like much money, and I know it may be a little more work for the retirement office because people do have questions about it, but I think the fairest thing to do is to make it 1/1, particularly since we're not even giving them a full inflation amount.
Mr. Chair, I have a question. When did we get the information?
We didn't get it till after, the January 18th is when the the Department of Labor released the statistics.
Then based on that information, I agree with Craig Freeman, make it a February 1st effective date.
Okay, so as a point of order, we have a motion to make it effective February 1st
At 2%,
at 2%.
and we need a second.
Second.
And we have a second on that. Now, what do we do about Carla's motion?
Well, she doesn't, he did not withdraw his motion.
Okay.
So this is the motion on the floor.
On the floor right
There
now.
was not a proposal to amend his, so we vote on this, and if it fails, then she can make another motion.
Okay, so we have a motion and a second on the effective date of February 1st with the effective rate of 2%. All in favor of that motion? Aye. All opposed? No. Motion carries. Okay. Thanks for your input, though, Carla. We do appreciate it. That's why you're here. Okay, item number 13B is sending attendees to the NCPERS Annual Conference, May 20th through May 24th, 2017, in Hollywood, Florida.
Move for approval.
Have a motion
Second.
and a second. Any discussion? Renee, when's the deadline? I saw it in there. There's an early bird registration, isn't
I
there?
usually try to get the early bird, but, I mean, if your schedules permit and you can give me the dates and time, that's fine. Normally, we like to have everything by at least April 1st.
Yeah, the early bird rate runs through April 25th, so
Right.
everybody should be able to get that. That's a savings of $200 per attendee if we can do it by April 25th. So if you're interested in going, please get with Renee prior to that date. Okay. Item number 14 is the investment consultant report. Yes.
Okay, good morning. We've handed out the January ASAP, the quarterly report, and the year in review. I'm really just going to talk from the January ASAP. The year in review, which is the clear cover bound piece, is something we put out annually. It covers economic market environment, global markets, and a lot of commentary and stats in there for those of you that are interested. I know the folks from Ernest and Times Square talked a little bit about the markets. I'm going to, and really focused on small cap. I think Pat from Ernest talked about volatility in the markets. I'm going to put it in a little bit different terms. As we think about the year, the first half of the year wasn't great. Really what we saw was stocks that were behaving more like bonds, offering a higher yield, were doing better. Bonds actually did well in the first half of the year, U.S. bonds, as interest rates were coming down. So that was a pretty big headwind for how this portfolio is positioned. The sectors in the equity markets that were doing well were REITs, as they mentioned, offering a higher yield, utilities, which is a small component of the equity markets, but offering a real yield, as well as other yield-oriented sectors. The tide really turned beginning in July after Brexit. We started seeing rates starting to pick back up, or expectations for rates picking back up, which then really catapulted after the election, and we saw 10-year Treasury yields move about 80 basis points from a low of close to 1.5 to almost 2.5 at some point during the fourth quarter. So that during the fourth quarter of the year, we saw bonds go from U.S. investment grade bonds go from over 5% to finishing the year at about 2.5%, meaning bonds were down, U.S. investment grade bonds were down about 3%. On the equity side, it was really a rotation in leadership. Those stocks that look like bonds that were really trading on yields or income started to decline pretty significantly, and stocks in sectors that were anticipating good things from either rising rates, so financials, or new fiscal policy or legislation really turned around. Energy, financials on lighter regulation, and industrials. Non-U.S. stocks didn't perform as well in developed markets. Emerging market stocks, while struggling in the first half, did really well in the second half, as actually the dollar declined a little bit. So as you look at numbers at the end of the year, I think most folks would think, oh, we must have had a great year based on what happened in the last quarter. And overall, for the year, your portfolio was up a little over 6%. So fairly modest returns. But then if you look now at the January numbers, the one-year return at the end of January, and this is so much, when are you measuring? The one-year return of the portfolio is up over 12%. So 1 month, you weren't up 6% in the month of January, but you're taking off one of the worst months of the early part of last year, January of last year, and adding a good January of this year, and the total fund return catapults by 6% for that one-year return. So as you look at the ASAP second page, the one-year return is 12.8%, 12.1 net of fees. Policy index up almost 14%. So pretty challenging. I think this second page of the ASAP is really good, just looking at from an asset allocation standpoint. Large U.S. stocks still led the way. Your large cap portfolio up almost 19.5%, so very good returns, trailing the benchmark a little bit. So you have predominantly passive implementation in large cap with the Intech. They're taking some deviations from the benchmark, and that's where you're getting at about 50 basis points. Small cap, you heard from your two small cap managers, great absolute returns, up 28% on a trailing one-year basis, but slightly trailing the index. Despite the struggles of Times Square over the last couple of years, we don't view that any issues or change in their philosophy or approach. I think it's always important to put things in perspective longer term. If you look at page 45 in the quarterly book, in the lower left quadrant of page 45, we show the growth of your initial investment, a growth of $1. So for every dollar you invested initially with them in 2009, and we track that relative to the Russell 2500 growth, which is their primary benchmark, and the Russell 2500, which is the core benchmark. And you'll see, out of the gates, you started off very well, and from that 2011 to October of 2015, the spread there is pretty wide relative to those benchmarks. So that dollar gaining more, and actually, for every dollar invested in 2009, by 2015, you had 2.6 times that investment. So very good return. More recently, certainly still earning significant dollars, but it's been a bit more of a struggle, but finishing up right about in line, about 2.5 times what that dollar was worth. So doing a good job over the long term. We recognize that active managers are going to go through periods where things are a little bit more challenging. And as they talked about some of the issues in the biotech space, we wouldn't expect them to be participating in that. From a manager standpoint, or just back to the ASAP, looking at the asset classes, overall, long short in a period where U.S. equities are up considerably. The long short is up 6.5% on a trailing one-year basis, ahead of the hedge fund index, but certainly not keeping up with long-only equities, which we wouldn't expect. This is an insurance portfolio, so we wouldn't expect it to keep up during that time. Private equity lags public markets, and you're up about 6.5% there. Relative to your policy index, we're measuring long versus the long-only benchmark in that one-year period, and so that's a bit of a headwind. But longer term, we think those make sense. The international portfolio Really, on the international side, on the this was a bit more of a challenge from a relative return standpoint in both EM and developed. So on the developed side, Harding Levner, your growth manager, had a really good year. Lazard struggled really from a positioning standpoint. They're the more value-oriented manager. In the fourth quarter, globally, value pretty significantly outperformed growth, and you think about from a sector standpoint, that's financials, some energy, and materials. And Lazard's, from a sector allocation, they're underweight financials. They thought financials were expensive, but even bigger impact was their underweight to materials. They had a pretty significant underweight to materials, and materials were one of the best performing sectors in the market, and that hurt them on a relative basis. In EM, the return there on a one-year basis, trailing by almost, it's up 11.5%, trails the EM benchmark by about 14%. Couple of things there. One, Von Tobel, the manager that was terminated, they actually, when the markets turned around, you still had some exposure there. That hurt a little bit as they weren't up as much during that transition. But bigger picture was the small cap exposure. The difference between small cap EM and the broader EM markets is pretty dramatic. So from a benchmark standpoint, the small cap EM benchmark was up 16.5% as opposed to 26% for the broader EM market, so a 10% differential. And then the manager, Wasatch, in small cap, underperformed that. So that small cap EM exposure hurt. More recently, as things start to turn around and EM has started to do better, both of those for the month, your Wells strategy is up 6.25% ahead of the benchmark, and Wasatch is up 4.25% in a 1 month period. So that's turning around a bit. A real bright spot in the portfolio, particularly in the second half of the year, was fixed income. As I mentioned, as rates began to tick up, your portfolio is really positioned to protect against rising rates or to add value in more level, low, sustained rates, as you have a lot of diversification there with the Western's Core Plus strategy that's doing some high yield, which did very well, non-U.S. and emerging market debt, and then the Brandywine strategy, which has a lot of, it's primarily non-U.S., and PAMCO, the absolute return hedge fund. You see your fixed income overall on a one-year basis now up 5.43. So that's the roll-up of all of those strategies that I just mentioned versus the aggregate, which is up 1.4%. And actually positive return for the month, but if we looked at the quarter ending December 31, the aggregate was down about 3%. So your bonds were positive. One note on PAMCO. Earlier this week, PAMCO is your lower volatility hedge fund manager, hedge fund to fund manager. They announced somewhat of a merger and a takeout of a minority partner, KKR, a large private equity firm that had an interest in another hedge fund of funds called Prisma, purchased 39% interest in PAMCO, which was really taking out some retired partners' equity that still held equity, and another minority equity holder, outside equity interest. So they took that over and merged Prisma with PAMCO. The operations are going to continue to remain separate. Prisma is a hedge fund of funds that's focused mainly on smaller investors, more retail investors. So their business is a little bit different. For the time being, they're going to continue to operate separately from an investment standpoint. The team led by Jane Buchan, who has been the chief investment officer at PAMCO, will continue to manage the strategies in the way they have. So at least at this point, we don't see any issues with that. They retain 61% of the ownership of PAMCO. So that just was announced earlier this week. The real assets overall, not just real estate, very good 1 year. Commodities, I mentioned the materials exposure for Lazard, that underweight hurt them. Finally, now we're seeing the commodities allocation benefiting. Commodities were up 15% on the year. 15.9% was the Gresham TAP Fund. Couple that with the Morgan Stanley Real Estate Fund, which was up 10.3%, and that's the combination is that 11.8% in real assets. So the real assets portfolio certainly benefiting and outperforming that benchmark. So overall, I think the measurement point is always interesting. You see what a difference a 1 month makes, catapulting that 1 month return by 6%. I think most folks would think, oh, at the end of the year we must have had great returns just because of you're seeing every day in the news what's going on with the Dow or the S&P, but it was really pretty isolated in a couple sectors, and other things for a globally diversified portfolio weren't doing as well. That's begun to turn around, and you're seeing these 1 year numbers in January looking a lot better. Just as we look forward, a couple of things. So we had 2 managers in today. We'll want to continue to do that, but one of the other areas next month we want to come back and talk about the private equity and opportunistic real estate allocations. We want to do an annual review of just planning as far as potential commitments there, and we intend to have some recommendations on some new funds, one specifically in the private equity space to complement the Warburg Pincus, which is more of a growth strategy. I think we're coming back with a recommendation on Apollo, which is a large global, consider them a more deep value type strategy in the buyout space, but we'll have information on that next month is our intention. And the last thing I wanted to mention, I don't know if Renee sent out, did you send it? Okay. Renee sent out an email yesterday. We're planning it's been probably a couple of years since we've done this, but we try to do an education session here in Oklahoma City for all of our clients here. We're targeting the last week of April. Hopefully that works. It will be here downtown Oklahoma City somewhere, probably on Tuesday, Wednesday, Thursday, one of those days. Generally do it from like 11 to 1:30 with lunch, so we'll get information out to all of you on that in the next week or so. Okay? All right, thank you.
All right, item number 15 is comments from board staff and citizens. Any comments? Words of wisdom? Okay, hearing none, we are adjourned at 10:57. Thank you.